Good afternoon, everyone. My name is Marissa, and I will be your host and administrator today. Welcome to the Abernathy Group Family Office June 2024 First Friday meeting. Today's presentation is titled Illusions, the Siren-Song of Prosperity. Why are we surprised so often? Today we will discuss why illusions train us to be surprised. What steps can we take to avoid the illusions created by the press and social media which create surprises? Also, how does the market create illusions, and how can we, as investors, become surprised less often? And finally, why do we forget that prosperity feels so great, yet history clearly documents that periods of prosperity become the siren song of disappointment? Our prepared comments during the session will be recorded, as other families who are unable to attend have asked us for the recording. Our comments today will be a bit shorter, at approximately 10 minutes long, as there have been a significant amount of questions from participants which are incredibly worthy of answering. If new questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box at the bottom of your screen, or write it down and raise your hand at the end of the prepared remarks by clicking on the reactions button at the bottom of your screen, and there will be an option to raise your hand. We really enjoy your questions, and we'll do our best to get to your question at the end of the prepared comments. One final note, please remember to mute your device's microphone and stay on mute unless you have a question, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary. Stephen, sorry, real quick, your microphone is muted if you don't mind just unmuting, and then I'll mute mine.
As I was saying, sorry about that. Welcome. My name is Stephen Abernathy, and this is the June 2024 First Friday meeting for the Abernathy Group Family Office members. Just a quick housekeeping detail. This is our 18th monthly meeting, and all of the meetings recordings are available on our YouTube channel and on our website. That's not a pitch. It's just they're available if you'd like to find out how we have been talking or what we've been talking about over the last several months. Today, we're going to discuss why we as investors are surprised so often. It's pretty remarkable. The amount of surprises are just amazing. What are illusions? What are today's identifiable illusions, and why do illusions often create a siren song of prosperity while simultaneously increasing the probability of disappointment to come? And of course, we're going to end with our best ideas about tactics that each investor can take to produce and at times avoid disappointment, which follows surprises. As most of us know, illusions are all around us. Most of the time, illusions are created by those trying to sell us a product or a service. And in those instances, our guard's up, so we don't fall prey to illusions in that instance often. When we are aware of the biased conversation, our guard is naturally up. Yet equally often, illusions are the second order effect of herd mentality or confirmation bias. Many times, illusions are convincing because they're believed by the majority. In an effort to keep our comments shorter than normal today, let's focus on the influence illusions may be having on our U.S. economy, which are influencing our stock and bond markets. Today, the stock market is valued at 21 times earnings and paying a 1.2% dividend. Is this a reasonable valuation based on all the information available describing our world and our economy? Most of us on this call are investors in real estate. So let me just use a real estate investment example because I think it's easily relatable to most. How many of you would buy a property that pays a 1.2% return on your investment each year, it's quite clear that acceptable rates in the 5 to 7% per year range for rents of properties are standard. Yet, would people really buy a piece of property at a price that makes that rent create a 1.2% return? I don't know. Maybe that's not fair. Let's refocus our comments on the stock market for the time being. So how many of you believe buying a stock with a 1.2% yield offers a high probability of that investment receiving a reasonable return over the next 5 years? And most of you might say, well, yield is only one dimension of the return, Steve. So you're not including the expected appreciation in the underlying value of the asset, which is delivering that 1.2% current return. So 1% plus return on top of this appreciation might be more fair. And that's a fair response. So however, what I would say to you is, upon further diligence, what happened if you found out that the asset's current value relative to history was in the 90th percentile, meaning that in 90% of the cases over history, the asset was valued at lower levels. So it's in the top 10% of its historical valuation. And what if you then found out that last year the asset's earnings increased 5%, which is great. The assets and its price increased by 30%. This means that during the last 12 months, the asset appreciated 6 times more than its earnings. So 6 times more than its earnings last year and at the 90th percentile. Would that change your interest in investing in an asset planning to pay you 1.2% over the next 12 months? Our belief, the market's expectations of earnings growth of 10 to 12% or more over the course of the next 5 to 10 years is unlikely to be achieved. So we think the market has priced in a future which is unrealizable. So I think the reasonable question is why? And why is the market believing this? And the answer is simple. Over the last 100 years, our U.S. economy, which we call our GDP, grew at just under 3% per year. So the reason we don't believe that a market can produce 10% earnings growth over the next 5 to 10 years is because our GDP, our U.S. economy, only grew by just under 3% per year for the past 100 years. So our stock market's earnings, which make up the majority of our nation's GDP, grew at just under 4% per year over the last 100 years. Now, over the last 20 years, our stock market has appreciated by over 10% per year on average. And because we had an interest rate, let me put that differently. Because we had interest rates at historically low levels, leverage at historically high levels, and taxes that were reduced to the lowest levels in the last 60 years, all three tailwinds supported appreciation. It's unlikely that we're going to have any of those tailwinds of those fortunate variables over the next 20 years. In fact, it's more likely that those tailwinds will become headwinds over the next 20 years because, as you know, we've talked about this every month, our nation is in a regrettable amount of debt, and we're running deficits that are obscene. So, with the stock market at more than 2 standard deviations above fair value, with a 1.2% dividend rate, we don't believe this is a fertile environment for investors expecting appreciation in securities. So let me keep going and move this quite along to our next topic, which is why investors are led along to this siren song of prosperity. First of all, for those unfamiliar with the aspects of a siren song, it's just a fable. I don't think it's a real thing, and it's described by an alluring melody which is convinced, which in the books convinced sailors to venture into unbecoming waters, and it's very similar to what we refer to as a mirage on land. However, the important point is that the media is incredibly talented in creating a narrative which is alluring by mixing some facts with a lot of fiction. So that's their siren song of prosperity. In short, all investors need to remember that that the media is paid by selling advertisements. It's not paid by delivering information to you. This means that they want your eyeballs and their attention, which means that the most um, drastic statement they can make is likely to pull the eyeballs along. So the best way to to get our eyeballs focused on their comments is to offer alluring information. At our firm, we say incentive dictates behavior, and this fully describes why the media's constant siren song leads investors to believe that the environment is much better than it truly is during good times, and it's probably much worse. It's probably not much worse than it truly is during tumultuous times. So, meaning we believe that the press exaggerates things on the positive side, and we believe that the press exaggerates things on the negative side. It's valuable to remember that as an investor, expectations are probably not as good as the world expects during good times, as I was just saying, and not nearly as bad as the world expects during difficult times. Now, why does the siren song of our current prosperity eventually lead to disappointment? The simple explanation to this question lies in the centuries of history, which clearly documents the fall of every single dynasty. As the slide shows, prosperity leads to lax behavior as citizens are more well off and they don't want their children to have to go through all the difficult periods or strife that the parents went through. So over time, work ethic tends to dissipate or tends to go down the drain. At the same time, recency bias, which is the tendency of a person to rely on information which is most recently available and weight that most heavily in their decision, rather than relying on the facts and the data, takes precedence over reasonable data and facts. So over time, the consistently over time, just the consistency of ignoring history and relying on recent events, reason becomes overwhelmed by the current events, and it tends to follow that being shouted by the talking heads, the newspapers, and the media. It's not helpful in trying to ensure you make intelligent decisions. So this brings us to today. Is our prosperity an illusion? Our training as analysts demands that we look at all sides of the coin and all data, and as you know that. And we try not to be swayed by recency bias or confirmation bias or any other bias. The bottom line is that our government has 125% of its debt, of its GDP, excuse me, in debt. Our deficit spending over the last 2 years averaged over 1.2 trillion, meaning that our government is pouring money into our economy, which gives us the illusion of prosperity, when in reality, we're digging a hole of debt that is clearly unsustainable. Of that fact, I am guaranteeing it's unsustainable. So as we brought up and asked last month in our first Friday webinar, we asked you a question. If there was a company for sale for $10 million that was losing $1 million per year in profits, yet had a rich Uncle Sam, which was donating $1.5 million per year into the company every year, just giving it to the company, thus allowing the company to show that it was offering the illusion of a $500,000 per year in profits. Would you want to buy this company for 21 times its profits? By the way, this means you're going to be buying the company for a little bit over 10 million a year that's losing $1 million per year. But by the grace of our generous Uncle Sam, it's showing a profit as long as Uncle Sam lives. So I don't know what your answer is, but as long as our Uncle Sam continues to contribute to the economy at the $1 trillion level year after year, all is well. However, the likelihood of this continuing is low, and when it stops, there will be hell to pay. Don't know when that is, and I'm not predicting. I'm not trying to be a doom and gloom person. I'm just trying to look at the facts. We believe our U.S. is in a period of prosperity today. It's true. Unfortunately, this prosperity is less than skin deep. We think it's an illusion, as it's being falsely inflated by fiscal spending at the administration level. And it has no return on investment. And at some point, this is going to end, and it's going to end badly. So, how do we defend our net worth against an economic backdrop with a high probability of having its tailwinds of good fortune turn into headwinds with a sword of Damocles over our head in the form of $35 trillion in debt? First, it's important for each investor to separate the signals from the noise. We've been through this in lots of meetings, so I don't want to bore you with that monologue. Remember, signals are data which offer insight into the future. These data are causal data, meaning they cause something to happen, meaning these signals, like the inverted yield curve, actually influence the future to come. As I was saying, to give you an example, the inverted yield curve is a great example of a leading indicator of a signal. It offers short-term rates which are higher than long-term rates. And as you know, banks borrow at the short-term rate level and they lend at the long-term rate level, which means they're paying more for their deposits that they can lend out than they're getting for the lending, which means they stop lending or they curtail lending or they decrease lending. This incents less borrowing. And in an economy like the US, which is dependent upon borrowing or debt to finance its growth, an inverted yield curve is meant to slow the economy. And it's never failed to slow an economy, with almost a 90% chance of throwing our economy into a recession. Because don't forget, our economy is like a huge ship going, ocean going vessel. It's hard to turn on a dime, and the more than likely, as I said, I think it's 87% of the time, our Federal Reserve throws us into a recession. The important point there is that it's not that we go into a recession, because we've been in recessions, every 4 or 5 years since time began. The problem is, today, when we go into a recession, we've got $35 trillion in debt, which means the risks are magnified significantly. So next, intelligent investors are going to follow the leading indicators as opposed to lagging indicators and data. Why? Because lagging indicators have little or no forecasting value. We as investors are trying to find the indicators and the data which tell us something about the future to come, and using lagging indicators is typically a recipe for failure. Lastly, the importance of diversification is highlighted or heightened during uncertainty. The rule worthy of, or the saying worthy of remembering, is the more you know, the less you diversify, the less you know, the more you diversify. So what that means is when you couple this rule, which you have to obey this rule. If you have certainty about something, there really is no reason to diversify. You should have all of your eggs in one basket. But to the extent that you don't know the future, and uncertainty today is incredibly high. We haven't even started to talk about the geopolitical dangers that could have significant effects and are not being priced in at all to our market. But when you couple this rule, which I would argue must be obeyed at all times, with the effort to avoid overconfidence, you'll arrive at the need for broad diversification during periods of uncertainty like we have today. Remember, each of us is wired to believe we are above average. When you take many studies at university level have been done, and they poll all of the people in the auditorium to tell them how many people are above average drivers. I think the return, the average of the return is about 87% of all of the people in the auditorium believe they're above average drivers, which seems to be uncomfortably high for me. But so remember, what I was saying is, each of us is wired to believe we're above average, and this coerces us to believe we're more right more often than we're wrong. And we call this overconfidence. And when you're overconfident in a market as sophisticated and as intelligent as the global capital markets are, you're competing against millions, literally millions of investors who are more well armed with technology and money than you are. So please maintain your humility when it comes to being invested, which means diversify. So this brings us to another topic, which may offer some help. Our U.S. stock market is overvalued, as the data suggests. So where do investors turn today? One way to diversify is to expand your subset of investment alternatives. So think outside the box a little bit. Currently, the non-U.S. markets offer much lower valuations and higher dividend payments of approximately 2.5% versus 1.2% in the United States. So here's a chart which compares the current valuations with the anticipated growth rates and dividend yields, and it clearly shows that the U.S. markets are more likely to deliver, that the non-U.S. markets are more likely to deliver appreciation than the U.S. markets. In fact, it shows that the U.S. markets over the next 5 to 7 years are likely to deliver flat to negative returns. And that's not an environment that you want to be plowing money into, in my opinion. It clearly shows that the emerging markets are the markets with the best risk-reward relationships and the highest dividend yields. So while we don't have time to defend or go into this more in depth right now, we can talk to anyone about some of the real details that underlie this data. And if anyone's interested in the data supporting this information, please email us or call us when your time allows. I'll take just one more moment of your time to point you to another study by a totally different company with they're incredibly responsible, and they are dependable, for thoughtful analysis. And it shows the same thing from a very different angle. So I know this is a very busy chart, and as I said, if anybody would like this chart, or if anybody would like to discuss the contents of the chart and why it's important, please let me know. as I clearly admit it's a very busy chart, and we don't have the time to go through each of the rows of data. But I think you can look at it in one fell swoop and see that the non-US markets are cheaper. They're probably equally risky, or maybe a little bit more risky in our opinion, and the dividend yield is double that of the US market. In summary, it's more alluring than the US market by a long shot. So let me stop here and check in to take the questions I believe we have on the docket so far, along with any new questions which may have come in during this discussion by anyone. Marissa, I think there were some questions that came in, so if you'll let us know what they are.
I have two questions which have come in. The first question is, the employment numbers came in this morning that were significantly above everyone's expectations, which signifies a stronger US economy than most thought. What does this mean for the probability of the US Federal Reserve lowering interest rates? And as a follow-on, if interest rates are not lowered, what does this tell us about the economy to come?
Well, that's some question. That's a really good question. I'm not just saying that. So the first thing I think it's important to remember is that this is just one data point. So relying on one single number is usually fraught with problems. The US economy is incredibly complicated. So this employment report is significant, but I don't think there's any conclusion yet that the U.S. Federal Reserve is going to draw from it. So I'm not trying to dodge the question. It's just that, as I said, these monthly numbers move up and down, and it's more likely that the value of these numbers, which by the way are lagging numbers, highlight very little information about the future. It's more likely to be valuable by averaging the last three of these numbers or the last six of these numbers, rather than 1 month's reading. Now, that said, the employment number today came in at 280,000-ish. This is 280,000 jobs that were created, or in context to an expectation of all of our economists that they were expecting 180,000. And the real number, the whisper number, which is whispered among all of the inside analysts, was 165,000 jobs were expected to be created. So 165,000 or 180,000 in reality, which came in at 280,000, that shows a huge surprise, and it probably means that any rate cuts scheduled for July by the Federal Reserve are clearly off the table. The economy, if you believe this number, the economy is much stronger than people think. And unless something in the economy breaks and we get some kind of trouble in the very near future, the U.S. Federal Reserve will be unlikely to lower rates. And by the way, as the U.S. Federal Reserve keeps interest rates higher for longer, each day, I just want to be on the record as saying this to you, each day, the probability of something which is unpredictable or an unpredictable event taking place increases. So the higher for longer rates tell us that the odds are increasing that we're heading for a recession. I hope this kind of answers the question, and if it doesn't answer it fully, give me a call after our call today. Marissa, is there one or two others that you mentioned?
Yes, another question. What is likely to be the consequence of all of the capital expenditures on artificial intelligence over the last year and planned for the coming year?
Oh, yeah, this is a great question. So as we all know, the AI boom continues to dominate the market. I think the statistic was in the first quarter of this year, or let me just give a more a broader indicator. In 2024, I think something like 93% of the earnings gain was delivered by the Magnificent Seven, which means that the 493 delivered less than 10% of the earnings that were calculated. So this narrowing of the market is almost unprecedented. It's not unprecedented. It's happened before, but each time it happens, the market has a significant downturn. The last time this happened was in 2000 with the internet boom. My point here is this. As you and I always say, we always talk about first and second order effects of what's going on. The market is solely focused on the expenditures taking place at the AI level. And when corporate CapEx is being spent, you must understand that the second order effect of this is that the corporation spending this money must have a return, or this is going to lead to disaster. Now, the point I want to make is that there's been something in the area of 700 billion spent so far on artificial intelligence ramp up, and there's expected to be another 750 billion spent over the next 12 months. So we're talking about well over $1 trillion in capital expenditures that need a return. And so far, other than Microsoft charging $30 a month for their Copilot, I don't see any returns being generated in additional revenue. So I'm not saying they won't come. I'm just saying that second order effects have yet to be realized, and these second order effects better be big time, and it better be more than cutting expenses by using less people, because if that's the only benefit that comes from AI, we're going to be this will be this I guess you would call it a tailwind of earnings in 2024 will certainly become a terrific gargantuan headwind for earnings in 2025. Okay. I hope that helps, and if it doesn't, please do call me back and we can talk about it more. There's a lot to discuss on that. Marissa, anything else?
Yes, we actually have a question from one of our participants today. Matt, go ahead with your question. Matt, sorry, I'm just trying to unmute your microphone, Matt, so you can ask. Give me 1 second.
Can you hear me?
Okay. Yep, all set. Thank you.
All right, great. Sorry about that. With the theme of Siren-Songs in mind, regardless of who's in power, I think there's a lot of evidence showing that decisions made during election years are often made in the interest or skewed in the direction of politics rather than long-term economic security. Could this indicate that there's a hidden risk in the equity markets, especially relating to valuations? If, for example, energy prices are artificially suppressed with the release from the reserve, rates are steadied when maybe they should continue to rise, or if measures are taken to temporarily stifle inflation, these things could be detrimental in the medium or long term. Could these things mean that companies are appearing healthier than they actually are? And maybe we won't find out until after the election, or maybe 6 to 12 months from now?
Man, that's a really deep question. And it's a really good one too. I'll tell you, I think that we've learned a lesson which is disastrous for us, that these little sugar highs that we've been introducing to the citizenry, or in the analogy of a doctor giving a drug addict, a small amount of drugs, and the small amount of drugs that get bigger and bigger and bigger, just to keep the drug addict out of his office. I think that we're we're heading down. We've borrowed money to the extent that it's ridiculous. We've borrowed energy now by the SPR, by pulling down the SBR, and we were supposed to have replaced that way long time ago. And I don't think we're at SPR levels that the petroleum reserve levels that are dangerous, but we certainly aren't where we need to be. So I just think, Matt, that this administration and maybe all administrations moving forward, we're just taking from the present, we're facilitating the present with whatever it needs to make people happy at the risk of our long-term prosperity. So your question is another dimension of what I would highlight as the illusion of prosperity. I really believe that. I think that we're living on borrowed time. It's sort of, as I've talked to many of you out there, if your next door neighbor earns, $50,000 a year, and they spend $100,000 a year every year on motorcycles and new pools and all kinds of things. And you scratch your head until at some point the banks just stop lending and he's just out of business. And that's not the way a responsible family should be run. Thank goodness the families that make up our family office, none of them run like that. Anyway, I'm off the subject, but the bottom line is I don't know politically what this means. I do know that it feels like to me both sides of the aisle are planning to spend. I know our budget for 2024 is 1.5 to 1.7 trillion deficit. It's ridiculous. And anyway, so I hope if that doesn't, Matt, if that doesn't answer your question, do call me and we'll have a conversation about it, because I have a feeling there was some more meaning in there that I'm not getting at. Or if you have a return, please do.
Yeah, as a follow-on, I'm wondering how could potentially bad government investments, for example, um, you know, bills, bipartisan or otherwise, that are passed that we see, limited activation or limited returns on. How does that trickle into the economy? And, also, I think somebody asked about the labor reports. Oftentimes in the last few months or over the last couple of years, the vast majority of those job gains have been in the federal government. Also could be, that's increased spending that maybe doesn't go away. But on the theme of just bad government investments, how could that potentially trickle into the economy and affect returns?
Yeah, it's just it is amazing. Every time we seem to hit a wall with spending more money than we're making, we put it on the Federal Reserve. We spend more at the Federal Reserve level. We spend more at the administration level. We spend more at the fiscal level. We spend more, and now they're figuring out that they can just hire more people. So there's a good argument to be made that says that the amount of our deficit, the 35 trillion dollars in deficit that we have, is a cumulative reservoir of bad investments. And when you think about that statement a little bit, it starts to ring pretty true. What I'm trying to say is, when you make a good investment, so you build a toll bridge or a toll road, and in the next 10 years, it's going to pay for itself. And so you spend, $2 billion building the road, and over the next 10 years, that $2 billion is paid back, and it continues to offer some revenue for the years to come. That means if our government had done that every year, we would have no debt. We would be we would be in the Clinton era again. So the fact that we've just figured out how to give money to people, both physically and at the Federal Reserve level, it's just a shame because it is the easiest way out, and it makes people happy fast, but the sugar high goes away. So I have a feeling I'm not answering your question terribly well, but I think what I'd like to try to convince each of our investors to go away with is that these deficits that we own now are a cumulative aggregation of bad investments, just investments. And now it seems like we're making investments that have no return, zero. It's just money down the drain. And that's just a shame. It'll end when the bond vigilantes come back, or when the world says no more. And that's going to be a really uncomfortable moment, as we said in our last First Friday meeting. Matt, does that get you where you wanted to go?
Yes, thank you.
Okay. Marissa, anything further?
No additional questions. Thanks so much, Stephen.
Okay. All right, guys. Thank you so much for attending. And if there are any additional questions that you felt more comfortable with one-on-one, please don't hesitate to call 212-293-3469. Otherwise, onward and upward. Thanks for attending.